What if the very banking regulations meant to prevent another banking collapse are quietly setting us up for the next one? Basel III was supposed to make the financial system safer, pushing banks to hold more liquid, risk-free assets like US Treasuries and mortgage-backed securities. But here's the twist. These so-called safe assets are now sitting on massive unrealized losses. And under the right stress conditions, those losses could pose a major threat to the banking system. In this video, we're going to unpack the hidden fragility baked into Basel III, why high-quality liquid assets might not be as liquid as regulators hoped, how interest rate shocks have already begun shaking regional banks, and what a forced liquidation spiral could look like on a global scale. Could the next financial crisis be hiding in plain sight behind the label of risk-free? Well, let's dive on in. The concentration risk in Western banks. As we discussed in this video, Basel III ensures a concentration of sovereign debt among Western commercial banks. And this, together with the divergence in the application of regulatory standards, promotes a divergence in bank reserve behaviour between the West and the emerging world. I'll link to this video at the end. Thus, Western commercial banks, from both a capital perspective, are encouraged to hold US Treasuries as Tier 1 assets to meet capital requirements and also to fulfill liquidity requirements, where an asset such as gold is penalised. During the crisis period of 2020 to 2021, ultra-low rates were utilised. At the time, banks faced weak loan demand and abundant deposit inflows. In search of yield, they purchased massive quantities of long-duration government bonds and agency mortgage-backed securities, MBS, instruments with minimal credit risk but substantial interest rate sensitivity. This chart shows the weekly yield on US 10-year Treasuries, which plunged to historic lows below 1% as the Fed cut rates and launched massive quantitative easing. This enabled governments to issue record alleged stimulus with artificially cheap financing, as we can see here. This period marked the peak of bond prices because remember, there's an inverse relationship between the price of a bond and the yield that it offers. A low yield means a high price and vice versa. When nominal GDP growth picked up, yields spiked, exposing duration risks and massive unrealized losses in the system. By Q4 2022, US banks held $5.43 trillion in securities, with $2.5 trillion in held-to-maturity portfolios, primarily treasuries and government-guaranteed MBS. By the way, MBS are rated as high-quality liquid assets when assessing bank liquidity. Crucially, many of these sovereign bonds are classified as held-to-maturity, HTM, on bank balance sheets. Under both US generally accepted accounting principles and international financial reporting standards, held-to-maturity assets, HTM, are not marked to market. Their book value stays constant regardless of market fluctuations. This accounting treatment enables banks to avoid showing losses on their income statements or capital base, even if market values collapse. From a regulatory perspective, these bonds seem ideal. They support demand for Western sovereign debt, as Basel III ensures they are treated as 0% risk weighted. Additionally, they counted fully towards liquidity coverage ratios as level 1 HQLA. But this regulatory treatment masked a growing sensitivity to interest rate risk, especially as bond durations stretched into the 10 to 30-year range. The turning point came when global inflation surged in 2022 and 2023 as nominal GDP had accelerated following massive monetary and fiscal stimulus programs. This prompted central banks, led by the US Federal Reserve, to raise interest rates aggressively. In less than 2 years, policy rates moved from near zero to over 5%, one of the fastest tightening cycles in modern financial history. The impact on long-term bonds was dramatic. A 20-year Treasury bond purchased in 2021 with a yield of 1.5% might lose 30% or more of its value when prevailing yields rise to 4.5 or 5%. Yet for bonds held in the held-to-maturity portfolio, these losses remained unrealized and unrecognized on financial statements. From an economic perspective, banks continue to sit on massive mark-to-market losses, but because accounting rules allowed them to ignore the drop in market value, the problem remained hidden from both regulators and the public, at least temporarily. No wonder there is a desire to get rates lower and reduce the threat of such losses. Every bank assumes that it can hold HTM assets to maturity, hence the name, and the majority of bonds from the low-rate era of 2020 to 2021 mature over 10 to 30 years. However, the sheer complexity of international finance can often pose a reality shock. In times of stress, whether due to deposit outflows, credit events, or shifts in investor sentiment, banks may be forced to raise cash. This is where the vulnerability becomes acute. If a bank's immediate liquid assets like reserves or short-term bills are insufficient to meet outflows, it must either borrow or sell securities. But selling HTM bonds requires reclassifying them, which typically means recognizing all unrealized losses in the HTM portfolio. A sale of even one security can trigger this reclassification, exposing the full scale of embedded losses. Once those losses are recognized, the bank's regulatory capital can be severely impaired. If capital ratios fall below required thresholds, the bank faces regulatory intervention, downgrades, and even market panic. Ultimately, capital weakness can undermine trust. As soon as a bank is seen as selling HTM assets at a loss, the illusion of safety evaporates. Investors and depositors who may have previously believed the bank was sound begin to withdraw funds or sell the bank's securities. The loss of confidence accelerates outflows, forcing the bank to liquidate more assets, further deepening the hole. This is precisely what happened with Silicon Valley Bank, SVB, in March 2023. SVB had over $90 billion in long-term treasuries and mortgage-backed securities, with more than $15 billion in unrealized losses. When it tried to raise capital and sell assets, the market panicked. Within 48 hours, a full-scale bank run was underway and the bank collapsed. The losses had been there all along, but only became visible when liquidity needs forced recognition. The Fed failed to act within its capacity as lender of last resort. It was simply another opportunity to centralize the banking system and undermine trust in regional banks. What makes this problem systemic is that many banks hold similar assets, often with similar accounting treatment. If one bank is forced to sell, it may drive down bond prices, worsening the unrealized losses at other banks. Markets begin to scrutinize balance sheets across the sector. The weakest links are identified and targeted. Banks respond by hoarding liquidity, reducing lending, and retreating from risk-taking, all of which have profound macroeconomic consequences. Even banks that never sell their HTM assets may be dragged into the panic if market participants assume they will eventually need to raise liquidity and sell. The resulting contagion could freeze funding markets and force regulators to intervene, as was seen in the broader US banking stress of 2023.
In this table, I highlight the vulnerability chain. This is how such a crisis could unfold. First, the buying of safe long-term assets which appear risk-free. Rates rise, bonds lose value. Liquidity needs arise while the banks are forced to sell. Losses are then realised and the panic then spreads. And then there's the risk of contagion across the financial system.
Western commercial banks have come to hold a concentrated share of long-duration treasuries due to Basel III's capital and liquidity incentives. This leaves them systemically exposed to interest rate shocks and contributes to a complex challenge. how to exit dollar dependence without triggering the very collapse the multipolar shift aims to avoid for now. A disorderly sell-off would crush Treasury valuations, crystallise massive losses, and ultimately destabilise economic interests. Instead, a slow, deliberate unwind is underway, diversifying reserves gradually, nurturing alternative payment systems, and allowing debt to mature rather than being dumped in crisis. This strategy is more than balance sheet caution. It's a calculated geopolitical manoeuvre. The goal is to erode dollar dominance while preserving the financial repression framework that sustains artificial demand for treasuries. Crucially, interest rates rose in response to rapid nominal GDP expansion post-2020, but as nominal GDP growth has slowed, as credit creation has been reduced, rate pressures are easing, allowing policymakers to manage unrealized losses without systemic rupture. Through careful credit and liquidity control, the oligarchic power structure seems to stabilize the value of treasuries while gradually shifting global monetary architecture. Basel III's hidden fragilities, including regulatory traps and liquidity illusions, may well become a critical fault line in this managed transition. Without careful restraint on credit growth and thus nominal GDP, interest rate pressures could resurface, amplifying embedded risks in the financial system. Yet this vulnerability, apparently designed to ensure stability, could actually be utilised later to deliver the shock needed to justify and accelerate a multipolar future when they're ready. And of course, interoperable CBDCs will come to the rescue at that point. Now, if you'd like to know more about this whole multipolar east-west divergence, do check out these videos and this playlist. Thanks so much for joining me, and I look forward to seeing you next time. Bye-bye.